Okay. First of all, thank you so much for joining in and welcome to the REG sparring session. Now, the topic which we'll be starting with today is individual taxation. REG 1, individual taxation. Now, individual taxation is one of the most important topics for REG for two reasons. One, again, 25 to 30% of your exams would be on individual taxation. So it's a very important topic from the weight perspective. There will be a lot of questions from this topic. Second, individual taxation acts as a foundation basis for understanding rest of the reg topics as well. So if you understand individual taxation well, you would understand corporate taxation, partnership taxation, S corporation taxation, all of the entity taxation much better because it acts as a foundation or the building base. And you have a comparative measure now. So again, it's one of the biggest and the longest topics in reg, and at the same time, one of the most important as well, right? Now, we will have approximately 7 to 8 sessions on individual taxation. Today is the first session in which we'll discuss Form 1040 overview. Then we'll have one session on filing status. We'll have approximately two sessions on gross income 1. We'll have two sessions on gross income, one session on above the line adjustments, one on itemized deductions and standard deduction. We'll have one session on QBI deduction, then on tax credits and other taxes. So we'll have roughly 9 sessions for individual taxation. 9 sessions for individual taxations. We'll have 9 sessions for individual taxation. We'll discuss each and every aspect of individual taxation in detail. This is the most important topic. 2 reasons. One, because it's the most weighted or the highest amount of questions from a particular topic will be from individual taxation. Secondly, it also acts as a foundation. If you understand this well, you will understand all the other topics well. It's the foundation of taxes. Now, thirdly, when we study taxes, right, the regulation exam has been divided. Regulation exam has been divided into 2 parts: taxes, tax, and business law. And the tax curriculum has been divided into, we'll understand how federal income taxes works for individuals, for C corporations, for partnerships, for S corporations, for LLCs, for trusts, for tax exempt organization, and property taxation for all the entities. Property taxation, how would property taxation or how would income tax on property be calculated? So we'll discuss from each of these perspectives, how do we tax each of these entities, including individual. And if you see, that's how reg curriculum has been divided. We have reg 1, which is individual, reg 3, C corp, reg 4, S corp, 5, partnership, LLC, tax exempt organization. We don't have trusts here. We have trusts in TCT. And reg 2 is your property taxation. So that's how your entire reg curriculum looks like. And today we are focusing on individual taxation. We have the very first session where we'll discuss again, how would individual taxation work? Now, individuals would self-assess their taxes, self-assess and self-declare. Individuals would self-declare their income, expenses, deductions, and self-calculate, self-assess their taxes and pay these taxes, self-assess and pay these taxes. And to do this, they will use a form called Form 1040. That's the form they'll use. That's the IRS form individuals use. I'm sure we are all very aware of it. We all pay our taxes. We all file our taxes using 1040, right? I think yesterday was a deadline as well, right? So yeah, right on point. So we'll again declare our income, expenses, and deductions, and you in this form, and use this to calculate and self-assess what is our annual income tax liability. Annual income tax liability. That's what Form 1040 is. So it's the federal income tax form for individual taxpayers. right? It is used to determine how much taxes do we owe, or is there a refund we are entitled to receive. Now, who should file Form 1040? First of all, we've understood Form 1040 is for individuals. Now, which individuals should file Form 1040? If your income, if your income is more than standard deduction, more than the standard deduction you are eligible for, right? Then you must, right? Or you are self-employed and net self-employment income is more than $400, you must file Form 1040, even if you have zero income tax liability. Very important to understand. Just because you have zero income tax liability doesn't mean you don't have to file taxes. Somebody could have $500,000 of income and they could have enough deductions that they have zero tax liability, but they still must file Form 1040. The only two cases where individuals are exempt and they are not required to file Form 1040 is if their overall income, right, is less than standard deduction, or they're self-employed and the net self-employment income is less than $400. In both the cases, right, they must file it. They must not file it, or else they must. So if your income is greater than standard deduction, right, you must file it. If it's less, you can ignore it. And if your net self-employment income is $400 or more, $400 or more, $400 or more. Understand it from both the sides, right? Both the perspectives. So if your income is more than standard deduction, you must file it. Or if your net self-employment income is less than $400, is more than $400, then you must file it. Either of the cases. Any of the conditions apply. And when do you file it? Form 1040 must be filed by April 15th, which was this Monday, which was the deadline, right? You must have filed your 1040s by then. Now, I understand IRS understands for some individuals it might be complicated. They might not have adequate information. They might not have adequate time to collect all the information and file their returns by 15th April. You can get a 6-month extension. You can get a 6-month extension. You can get a 6-month extension, right? And that means you can have additional 6 months to file your return, which means you can file it by 15th October. Now, this extension is only for filing, only for filing. Taxes are still due on 15th of April. So, Form 1040 must be filed by April 15th. You have the option to obtain an extension for October 15th. Now, what is the form? Form 4868 gives you the extension. Do you need to remember this form number? No, it's just for informative purposes. You don't need to remember this form number. Form 4868 grants a 6-month extension, right? It does not extend the time to pay, it's only to file. Now, for taxpayers who are outside United States, they have an automatic 2-month extension. They have a 2-month relief. So instead of 15th April, their deadline is 15th June. 15th June. Their deadline is 15th June. So 2-month automatic extension is available to them. 2-month automatic extension is available to them without filing any form. 2-month automatic. But if they want the full 6-month extension, they must also fill Form 4868. If they want the full 6-month extension. 2-month extension default is available to them automatically. They don't need to do anything. So their deadline is 15th June, not 15th April. But if they want the full 6-month extension, then they have to again file Form 4868 such that they can file their taxes by 15th October. Payment is still due by April 15th. If you don't pay by April 15th, you will start incurring interest and penalties on the amount due. Now, we have a skeletal structure of Form 1040. Like, how do we calculate our income using Form 1040? We have a detailed skeletal structure here right now. We'll look at this and then we'll discuss each item in detail. First, we have our gross income. Right? So when we start filling up our form, we'll accumulate all the sources of income and put the details here. We'll take 2 classes or 2 sessions to discuss that. We'll discuss each and every aspect of gross income: wages, salaries, business income, again, capital gains and losses, interest and dividend income, farming income, other income, again, all these sources of income. First, we'll put all our income together in this. We'll discuss each and every component of income in 2 sessions. Then we will subtract from that above the line adjustments. We'll have one session on this, where we subtract all the above the line adjustments. We'll discuss each of that in detail as well. What are the above the line adjustments? Your IRA contributions, right? Your, again, self-employment taxes, your HSA and MSA save contributions. All of this will be deducted such that you arrive at AGI. Then we will discuss how to calculate your standard deductions or itemized deductions. And we'll have one session on that. You can choose either, and we'll discuss this in detail as well. Then we have taxable income before QBI, and we'll have one session on qualified business income deduction. Once we deduct that, we'll have a taxable income. We'll multiply that with the tax rate and get our federal income taxes. From this federal income taxes, we can subtract our tax credit. We'll have one session on that as well, on all the tax credits which we have. And we'll add some other taxes which we have, which is your self-employment taxes, estimated payment and holdings, and we'll have one session on that. And with this, we'll have a total of 8 sessions, 6 sessions on this, plus we are having 6 sessions, sorry, we'll have 7 sessions on this, plus one session on overview of Form 1040 and one session on filing status. 9 total will make your entire individual taxation. We won't be discussing alternative minimum taxes in REG. We'll be discussing it in TCP. It's part of the TCP curriculum. But are we clear with what Form 1040 is? Who must file Form 1040, right? What are the filing deadlines and what is the skeletal structure? So you have your gross income, from which we subtract our adjustments, above the line adjustments. We get our AGI, from which we subtract either standard deduction or itemized deductions, which we get taxable income before QBI. We subtract our QBI to get taxable income. We multiply it with our effective tax rate or the slab rates, and we get our federal income tax liability. We subtract tax credits. We add alternative minimum tax. I want you to note it. We'll not study it here. We'll study it in TCP if you decide to choose it. We will again add self-employment taxes. We'll subtract any estimated payments we have made in advance or any withholdings, and we'll get our taxes due. Are we clear with this? Are there notes available for us to follow along? Are you able to see the Excel which I'm sharing? Yes, no. Yes, is the file available to download? Yes, all of this, right? So if you go to the sparring replays, you will see against every topic, there is an Excel link. You can just simply click on this, right? And it will have all the topics. Now, what we do is we keep on updating these Excels every time we do it. So always remember to download the fresh one. After every session, download the fresh one. You can just simply click on download and it'll download for everyone. So you can just open the Excel and download it from the Dropbox link. Are we good on how to use this? You can download all the files for all the REG topics. Perfect. Now, we have understood what Form 1040 is, who must file it, right? So if your income is more than standard deduction or your net self-employment income is more than $400, you must file it, when to file, and what is the overview. Now, for individual taxpayers, right, they can report their income and expenses. Individual taxpayers or any taxpayers, right, they can report their income and expenses either under cash basis or under accrual basis. Now, even before we discuss this, I want you guys to think and tell me, what is cash basis and accrual basis? You should know this, what cash basis and accrual basis is, from your accounting lectures. Now, even for taxes, you can report your income and expenses either using cash basis or accrual basis. Now, what is this? if you can give me a broad definition or explanation on this. Cash is what you received. Accrual is for when the services are performed. Correct. More or less correct. Under cash basis, income is recognized when received and expense is deducted when paid, regardless of whichever period they pertain to. So there can be a 2015 expense which I'm paying today. It will be deducted today, not in 2015. There could be a sale I made in 2020 for which I'm receiving the income today. It will be shown as income in 2025, not in 2020. So it doesn't matter when you earned it. Income is recognized when received and expense is deducted when paid under cash basis. Whereas accrual basis is the opposite. Income is recognized when earned and expense is deducted when incurred, not when paid, regardless of when they are paid or received. It doesn't matter. So I could have made a sale today, right? I might receive the cash 2 years later, but the income will be recognized today as per accrual basis. Similarly, let's just say my insurance for the current year, I might not have paid it. I'll pay it 5 years later, right? Or 3 years later, but it will be deducted as an expense today itself. Today itself, when it's incurred for the period which it pertains to. That's the difference between cash and accrual base. Now, how does it work for taxes? Right? Now, under taxes, you can use cash basis, right? You can use cash basis. Now, under this method, income is recognized when actually or constructively received. So income is recognized when actually or constructively received. Like I said, income is recognized when received. We are adding two words, actually or constructively. Actually means you have received it in cash. Constructively, as in it's available for you to receive, you're not receiving. For example, let's just say you sold a particular product to your customer. Now, customer has signed the check and customer is like, hey, Mike, the check is available. You can pick it up whenever you want. And I don't pick it up for another few months. It is received. It is constructively received when the customer has offered to pay. And expenses are deductible when paid. Now, small businesses and individuals, we all use cash method of accounting. Now, you are eligible to use cash method of accounting if your average business, right? Small businesses can use it if their average annual gross receipts, So their average turnover, right? For the preceding 3 years, for the last 3 years, their gross turnover is less than $30 million if you're calculating it for 2024, 31 million for 2025. This gets updated. This number gets indexed for inflation every year. You don't need to memorize it, but we'll discuss this number so many times that you'll automatically remember it. I think it's very natural that you'll remember it, but you're not expected to memorize it. So, what is cash basis? Right? Cash basis is income is recognized when actually or constructively received. Expense is deducted when paid. That's one, right? That's the first thing. Now, who is eligible to use cash basis? If your gross average gross receipts, whatever you've received, right? Total receipts for the last 3 years, the average for the last 3 years, right, is less than 30 million. This is the number. This is the threshold for 2024. Now, if you're writing your exam before June 2025, this is the number applicable. If you're writing your exams from July 2025, the 25 numbers are applicable, which is 31 million. You're not required to remember this number. It's good to, you should eventually, because we'll discuss this number so many times across individual corporate taxation. But the threshold is $30 million. Your average turnover, average gross receipts for last 3 years is less than $30 million for 2024, 31 million for 2025, if you're calculating it in 2025 for 2025 returns. Right? Now, income. Income is recognized when actual or constructively received. as we have discussed. Either you've received it or it's available to be received. It's ready. You're not taking it. That's constructive. Expenses are deducted when paid, but there are some some exceptions. What is the first exception? Capital expenditure. When you again make an expenditure where you'll receive benefit for over a year, for more than a year, right? Which will go into the next tax year as well. In that case, it is not immediately deducted. It is capitalized and depreciated or amortized, right? For example, let's just say you buy a machinery for use in business. You buy a computer for use in business. Now, will this machinery and computer go on for more than a year? Will give you benefit for more than a year? Most probably, yes. So you will not expense it immediately. You will capitalize and depreciate or amortize. That's one exception. Like I said, first rule is expenses are immediately deductible when paid. But exception number one, capital expenses or any prepayments where you will get benefit over more than 1 year is not immediately deductible. Instead, they should be amortized over that period. Let's just say I prepay my insurance for 3 years. I prepay insurance for 3 years. Will I get benefit for more than 1 year? Yes. Is it deductible in that case? No. Only for this particular year. Capitalize and depreciate or amortize. And this should tell you how IRS is smart for it. See, with this exception, what IRS has done is income is recognized on cash basis, but expense is recognized on either cash or accrual, whichever is later. Because see, you're getting cash for accrue expenses. You can prepay expenses for 5 years, but can you deduct it? No, you cannot. This is basically to make sure IRS doesn't allow people to have those tax planning strategies here, where in a particular income, if you have very high income, you can pay a lot of taxes to come to a lower tax bracket. You cannot do that. To avoid that, expenses are not immediately deductible if the benefit from that expense is for more than a year. Now, if the benefit is for 12 months only, right? But it is going to the next tax year, it is expensible. But if the benefit is for more than a year, you capitalize and amortize it. Are we clear with this? So if you see, this is not actual cash basis. IRS has made tweaks to the cash basis. Income is taxed. Income is recognized on cash basis. The moment you make the income, it becomes taxable. The moment you receive it, right? But expenses are cash basis, but if you're paid in advance, that is not deductible. If you haven't paid this year, it's not deductible. We'll have to wait till it's paid. So later of cash or accrual. And if you paid in advance, it's not. So it's deductible only when it's accrued and paid in taxes. So both has to happen. If it's not accrued and you've paid it, not deductible. Now, prepaid interest must be deducted over the loan period and not when it is paid. Now, for inventory, normally inventory is always maintained as per accrual basis, COGS and inventory, right? And for that, we have something called uniform capitalization rules. Now, small businesses, again, the same threshold where your average annual gross receipts is less than 30 million for 2024 or 31 million for 2025 in the last 3 years, you are not required to use accrual method for inventory. You will treat inventory as materials and supplies where you can expense it when you purchase it. Right? So expense the cost of the inventory when you first use it or when you're first selling the inventory, you can expense it, right? That's one option. Or if you're having books, if you're having accounting books, right? These are tax books. If you're having accounting books where you are having accrual method for inventory, you can use the same amount of inventory for tax purposes as well. So inventory, right? If your average annual gross receipts is less than 31 million for 2025 or 30 million for 2024, right? For the last 3 years, you are not required to use accrual method and use uniform capitalization rules to calculate inventory. You're not required to, right? You have two options. Either you treat inventory as materials and supplies where you're expensing it as soon as you purchase it or as soon as you use it or sell it. Or whatever inventory you have calculated for accounting, you use the same inventory. This is cash basis. This is cash basis. Are we clear? Just to summarize, income is earned when received, actual or constructed. Expense is expensed when paid. Exception number one, capital expense where you get benefit for more than a year. Capitalize and amortize. Prepaid interest expense, not deductible. Even if you pay it advance for 3 months, it's not deductible. For 3 months also, it's not deductible. Inventory. Now, any small business, right? They don't need to use uniform capitalization rules for inventory. They can use inventory as materials and supplies where the moment they purchase it, they can expense it earlier or when they've used it or sold it. Or if they're maintaining accounting books, whatever method they have for accounting, you can use the same inventory as well. Now, for accrual basis, right? Income is recognized when earned, and expense is deductible when incurred for the period which they pertain to, regardless of when they are paid or received. It doesn't matter. So under accrual method, income is recognized when all events test is met. What is all events test? You have, again, think of it from revenue recognition perspective. If you've done far, think of it like revenue recognition. So all the events have occurred for you to have the right to receive the income. Think of revenue recognition. You have completed all the 5 steps such that you have the right to receive the income. And the amount you have to receive is determined with reasonable accuracy. So under accrual method, income is recognized when earned, regardless of when it is received. And expense is deductible when incurred and the period it pertains to, regardless of when they are paid. It doesn't matter. Now, for income, right? For income, try to understand to recognize the income, all events test must be met. What is the all events test? All the events which are required to be completed to establish your right to receive the income has happened. Basically, you have established the right to receive the income. When do you establish the right to receive the income? When you have done your part of the job. So all the performance obligations, what it basically means, all the performance obligations have been met. 5-step revenue recognition, all 5 steps. Think of it simply, all 5 steps of revenue recognition are done. Second, you can estimate the amount. Only then income is recognized. Only then income is recognized. That's one. And the second rule is for conformity with accounting, for conformity with your accounting. First of all, are we clear with this? All events test. So for income to be recognized, you must have done all responsibilities you were supposed to do. But there's a caveat. You cannot recognize income for taxes no later than year in which you recognize it for accounting. So if you have booked a particular income, right? If you have met all the 5 performance obligations and you have recorded the income in accounting, record it in taxes as well. You cannot record an income in accounting and not record it in taxes. It is quite possible you can record it in taxes, but you still think you haven't met all the steps to recognize it in accounting. There's some difference between all events test and the 5-step revenue recognition model. There's some differences. Now, it's okay to recognize income in taxes before accounting. That is fine. But if you have recognized the income in accounting in a particular year, make sure